Hey everyone, and happy Mortgage Tip Tuesday. It's my favorite day of the week because I bring you information and education to hopefully help you through your home buying or refinancing journey. I try to keep up to date with all of the rules and the changes in the guideline, and then I bring that to you to hopefully help your home journey become an easier one where it's less stressful. So today is tax day. Today is the day where your taxes are due, or you better have filed an extension to make sure that they do not come after you. And so, because it's tax day, I wanted to share some important information because a lot of the times you may end up owing taxes, and maybe due to the economy or your financials, you can't pay that balance in full. So I think it's important for us to go over those guidelines and talk about, well, what happens if I owe the IRS? So I'm going to make myself small and I'm going to share my screen. We have something here called Ask Alice, and that is our portal that helps us ask any type of question to hopefully provide the right answer so that we can transfer that answer over to you. Okay. So I'm going to share it. Obviously, I put here due outstanding IRS tax balances need to be paid off prior to closing. When I do search this, it's right here at the top. And obviously, you don't have access to this, but we do. And it says on here, IRS tax amounts or balances owed may be handled differently based on a variable of factors, and wants me to answer some of the questions below. So of course, everything is different based on loan type. And so I'll go through two of them today, which is conventional and FHA, and only because those are the most popular loans that we get requested. So on a conventional loan, it says on here, IRS outstanding tax amounts owed must either be paid in full or added to the monthly debt obligation where an IRS installment payment agreement has been made. So let's be clear, there has to be an official IRS installment arrangement in order for us not to have that need to be paid in full. Okay. So it says, has a tax lien been filed for any part of the outstanding tax balances owed? For now, we're going to select no, and just show you that if, again, it says here, has the borrower entered into a payment arrangement? So we're going to say yes, okay? So when we get that answer, it says non-delinquent tax balances for borrowers who have entered into a payment arrangement with the IRS may be eligible to add the tax debt as a monthly obligation liability in lieu of paying off the tax balance, subject to all of the following terms being met. One, no tax lien has been filed for any part of the tax balances owed. And then two, at least one payment from the arrangement has been made prior to closing Fannie Mae loan. And then obviously a Freddie Mac loan does not have that same condition. And then it says we need documentation that to support an approved IRS installment agreement, including the terms of repayment, the monthly payment amount, the total due, and evidence that the borrower is current to date. So acceptable documentation includes the most recent monthly payment reminder statement from the IRS reflecting the last payment amount and date, and the next payment amount and due date. Okay, so it says here, note, delinquent tax debt must be paid in full regardless of if there's a formal payment agreement established or not on a conventional loan. So you definitely do not want to go delinquent. Now I am going to change this one, has the borrower entered into an IRS installment payment arrangement, because sometimes it takes a while for that arrangement to be agreed upon if they're even going to agree on that. So if I change that to no, then it says here that Union Home Mortgage requires that all outstanding IRS tax balances greater than $5,000 need to be paid off and sourced prior to closing. For non-delinquent tax balances that are less than or equal to $5,000 and do not indicate, a tax lien has been filed, Full payoff for the outstanding balance may not be required if the borrower has sufficient assets covering the tax balances owed, in addition to all required funds needed for closing, including reserves. So what that really means, let me break it down to you. I just gave you a whole bunch of doctor information, right? And now you want to know, like, well, what does this all mean? So if it's more than $5,000, we're going to require that to be paid. And when it says sourced, meaning we need to know where that money's coming from, to make sure that you're not borrowing money, because if you are, then we need to um, include that monthly payment. That may change your qualifications. So we definitely need to make sure it's sourced. But if the balances are less than $5,000 and it's not delinquent, then what happens is we just need to make sure that your bank account shows that you do have the money to cover this, even after you have closed, after you close on your, even after the financials for closing your home, to include down payment and all your closing costs. And if you're required to have any reserves, it has to be in addition to that. Okay, that can be a bank account, whether it's checking or savings. That can be 401k. That can be stocks and bonds, something that can be liquidated to cash. Okay, so that's important for you to understand. Now I'm going to change this. If a tax lien has been, is there an outstanding tax lien? Because it's important to know that. So if there is an outstanding tax lien on a conventional loan, and it says delinquent taxes are defined as tax amounts owed where a tax lien has been filed. Delinquent tax balances indicating a tax lien has been filed on conventional loans must be paid off at or prior to closing, regardless of whether they are on a structured IRS repayment plan for the tax lien amounts or not. So basically, if it's delinquent, it must be paid at closing or prior to closing. And of course, we're still going to have to source where those funds are coming from. Okay. So hopefully that helps you on conventional. And then let's go to FHA. Again, it says tax liens may remain unpaid if the borrower has entered into a valid repayment agreement with the tax lien holder to make regular payments on the debt, and the borrower has made timely payments for at least 3 months of scheduled payments. And it's very important to understand you cannot prepaid scheduled payments. So if the payment says on the arrangement that every 15th of the month you owe this amount and that's when it's due, you want to make sure that you make those every, I say before the 15th, because on mortgages, if it's delinquent or it's past due, past the due date, that could count against you. So again, you can't just pay 3 months in advance because you're trying to buy a home today. Okay. So it says, except for federal tax liens, the lien holder must subordinate the tax lien to the FHA insured mortgage. And it says the lender must include the payment amount in the agreement in the calculation of the borrower's debt to income. So when we get that a payment arrangement, if it says, hey, this borrower is paying $75 a month, we will add that to your debt to income to make sure that you still qualify with your new debt to income that includes that actual payment arrangement. We do check public records and credit information to verify that you are not presently delinquent on any federal debt, and does not have a tax lien placed against their property for a debt owed to the federal government. And it says include documentation from the IRS evidencing the repayment agreement and verification of payments made if applicable. So I did give you a ton of information, but the reason why I give you a ton of information, because it's very important. Sometimes people believe because they owe the IRS that they don't qualify, and that's not necessarily true. We just have to have all of our ducks in a row, and making sure that we have the documentation to back up what type of a payment arrangement you are in, or we need to get you into one, and then obviously we have to wait the terms of how many payments you need to make in order to qualify, and then we track those payments. And so hopefully this helps you. You don't have to be nervous about owing the IRS. Honestly, just me being personal, we owe the IRS every month, every month, not really. We owe them every year, and we have to pay that. But some people don't have the cash to pay that in full. And so there have been times where you have to enter into a payment arrangement. And there's nothing wrong with it as long as you follow those guidelines and you make sure that you pay everything on time. It doesn't affect your mortgage. Again, we just include that payment in your debt to income to make sure that you still qualify for the amount that you want. So I hope this information is helpful, and that it doesn't stop or hinder your belief that you can still buy or refinance. If you have any questions about anything, fear is not the answer. Just ask the question. There is no dumb question in a mortgage, and I'm happy to provide the answer to you. As always, I say JLoan for your home loan. So if you have any questions, you need help with a mortgage, you want to know if you qualify, or you want to refer me a family or friend, you can reach me at 817-601-5456. Until next Tuesday, I want you to be safe, but most importantly, I want you to stay blessed. And I'll talk to you then. Bye bye.